Something extraordinary just happened in the gold market that almost nobody is talking about. And if you miss what this means, you could be leaving serious wealth on the table over the next 12 to 18 months. Gold just broke out to all-time highs in virtually every major currency on the planet. The Japanese yen, the British pound, the euro, the Australian dollar, the Canadian dollar. One after another, gold has been smashing through resistance levels that held for years. Charts that looked range-bound for the better part of a decade suddenly look like they're going parabolic. And here's the thing that should make your ears perk up. There's one major exception to this pattern. One currency where gold hasn't broken out yet. And that exception tells us everything we need to know about what's coming next. But let me back up for a second, because most people don't realize why this matters. When gold breaks out in multiple currencies simultaneously, it's not just a technical event. It's not just lines on a chart doing interesting things. It's a coordinated loss of confidence in fiat currency systems around the world. It's billions of dollars of capital saying the same thing at the same time. We don't trust where this is going. Think about what it means when gold hits a new all-time high in yen terms. Japanese investors, sitting on one of the largest pools of savings in the world, are watching their purchasing power evaporate. The yen has been in a controlled demolition for 2 years now. The Bank of Japan tried to defend their currency, burned through foreign exchange reserves, and ultimately had to capitulate. And now Japanese investors are looking at gold the same way their grandparents did after World War II, as the only real money that survives currency crises. The same story is playing out in Britain. Gold in pound sterling terms just broke through levels we haven't seen since the pound existed. British pensioners who lived through the 1970s remember what inflation does to fixed income. They remember when a comfortable retirement turned into choosing between heating and eating. And they're not waiting around to see if history repeats itself. They're moving capital into hard assets while they still can. In Europe, the situation is even more precarious. The euro was supposed to be the currency that challenged dollar dominance, a unified monetary system backed by the economic might of an entire continent. But what we're seeing now is the fatal flaw in that design becoming impossible to ignore. You can't have one monetary policy for 20 different economies with 20 different fiscal situations. Germany wants austerity. Italy needs stimulus. France is somewhere in between, and the whole thing is held together with political duct tape and central bank intervention. European investors aren't stupid. They see the cracks, and they're buying gold like their financial lives depend on it, because increasingly, they do. Australia and Canada, commodity-rich nations that should theoretically have strong currencies, are watching gold break out in their terms too. Think about what that means. These are countries sitting on vast natural resources: oil, natural gas, iron ore, copper, wheat, everything the world needs to function. And yet their currencies are weakening against gold. That tells you something profound about the global monetary system. It tells you that even resource-backed currencies aren't safe when the entire fiat experiment is losing credibility. Now here's where this gets really interesting. The one major currency where gold hasn't broken out to new all-time highs yet is the US dollar. Gold in dollar terms is close, very close. We're talking about a few percentage points away from the 2011 highs around $2,100 an ounce. But we haven't decisively broken through and held above that level. Not yet. And this is the part where most analysts get it completely wrong. They look at this and say, see, the dollar is still strong. Gold's breakout in other currencies just reflects dollar strength. The US is still the safe haven. But that interpretation misses the entire point of what's actually happening. The dollar hasn't broken out yet because it's the last domino. It's the final currency that global markets are clinging to before they have to face the reality that there is no safe fiat currency anymore. The dollar is the reserve currency of the world. It's what central banks hold. It's what international trade is denominated in. It's the foundation of the entire post-1971 monetary system. And when gold breaks out in dollar terms, when it decisively takes out those 2011 highs and starts making new records, that's not just another technical breakout. That's the market saying the foundation itself is cracking. Let me paint you a picture of what happened in 2011 and why this time is different. Back then, gold hit $1,900 an ounce in the aftermath of the financial crisis. Central banks had just started quantitative easing. The Fed's balance sheet had exploded from $800 billion to over $2 trillion. Investors were terrified. They piled into gold as a hedge against currency debasement and potential hyperinflation. And then, something interesting happened. The Fed stopped QE. They started talking about normalizing policy. Interest rates began to rise, and gold entered a bear market that lasted years. A lot of people got burned in that decline. They bought gold at the top, watched it fall 40%, and swore they'd never touch it again. And that psychological scar is still there in the market. That's why even now, with gold at 1900, 2000, 2100, you still hear people saying it's a bubble. It's going to crash like it did before. But here's what they're missing. The circumstances today are completely different from 2011. In 2011, the Fed's balance sheet was $2 trillion, and people thought that was insane. Today it's over $8 trillion. In 2011, the federal deficit was $1.3 trillion. Today it's approaching $2 trillion in a supposedly strong economy. In 2011, total U.S. debt was $14 trillion. Today it's $34 trillion and climbing by $1 trillion every 100 days. In 2011, we had just gone through one crisis. Today we've gone through multiple crises back to back, and the government's response to each one has been to print more money and add more debt. But the biggest difference isn't even the numbers, it's the trajectory. In 2011, there was still a belief that we could normalize, that we could shrink the balance sheet, raise rates, get back to some version of sound money. That belief is gone now. Everyone from the Fed to the Treasury to Wall Street knows we're trapped. We can't raise rates meaningfully without crashing the economy. We can't stop deficit spending without triggering a depression. We can't shrink the balance sheet without breaking the bond market. We're stuck in a debt spiral with only one way out, and that way is currency debasement. And the smart money knows this. That's why central banks have been buying gold at a record pace for 2 years straight. In 2022, central banks bought over 1,000 tons of gold. In 2023, they bought over 1,000 tons again. These aren't small players. We're talking about the People's Bank of China, the Reserve Bank of India, the Central Bank of Turkey, the National Bank of Poland. Countries that hold hundreds of billions in foreign exchange reserves, and they're systematically converting those reserves from dollars and euros into physical gold. Why would they do that? Because they see what's coming. They understand that when you have unsustainable debt levels and political systems that can't make hard choices, the only solution is inflation. Not the 2% inflation that central banks target. Real inflation. The kind that cuts the value of currency in half over a decade. And gold is the only asset that maintains purchasing power through that kind of environment. Now, let's talk about what happens when gold breaks out in dollar terms. Because it's not just going to be a technical event on a chart. It's going to trigger a cascade of capital flows that could reshape the entire financial system. Right now, there are trillions of dollars sitting in bonds yielding 3, 4, maybe 5%. Investors holding those bonds are already losing money in real terms when you account for actual inflation. But they're holding on because they don't know where else to go. Stocks feel overvalued. Real estate is expensive. Cash is being debased. So they sit in bonds and hope for the best. But when gold breaks out and starts making new highs week after week, month after month, that calculus changes. Suddenly there's an alternative. An asset that's not just preserving wealth but growing it. An asset with no counterparty risk, no default risk, no political risk. And when that realization hits, when the institutional money starts flowing into gold, we're not talking about a modest rally. We're talking about a potential moonshot that could take gold to $3,000, $4,000, maybe $5,000 an ounce over the next few years. And here's the part that most people don't understand. That kind of move isn't bullish for gold. It's bearish for everything else. Because if gold is going to $5,000, that means the dollar has lost more than half its purchasing power. It means your salary, your savings, your retirement account, everything denominated in dollars, has been cut in half in real terms. That's not a win. That's a catastrophe that you can protect yourself from if you position correctly. But a catastrophe nonetheless. Let me tell you about what happened in the 1970s because there are eerie parallels to today. In 1971, Nixon closed the gold window. He ended the convertibility of dollars to gold and ushered in the era of pure fiat currency. For a few years, nothing much happened. Gold drifted higher, but it wasn't dramatic. People still trusted the system. But then inflation started to accelerate. Oil prices spiked. The cost of living soared. And suddenly, everyone wanted gold. From 1976 to 1980, gold went from $100 an ounce to over $800, an eightfold increase in 4 years. But here's what's important. That wasn't a smooth ride up. There were massive volatility swings, corrections of 20, 30% that shook out weak hands, media calling it a bubble at every stage, experts saying it had gone too far. And then it would consolidate and rip higher again. The people who made life-changing wealth in that era weren't the ones who tried to trade it. They were the ones who understood the macro picture, accumulated physical metal, and held through the chaos. We're setting up for a similar dynamic now, except the scale is much larger. The amount of currency that's been created, the level of debt in the system, the number of people who are going to need to protect their wealth. It all dwarfs the 1970s. And that means the move in gold could be proportionally larger too. Now, if you're sitting on $100,000 or more in retirement accounts, this is where you need to pay attention. Most people have their retirement savings in stocks and bonds, traditional 60-40 portfolios. And those portfolios are designed for a world where currencies are stable, inflation is low, and governments are fiscally responsible. That world doesn't exist anymore. And if you're not adapting your strategy, you're taking on massive risk without even realizing it. I put together a free guide on how gold IRAs work. It's in the description below. It walks through how you can get physical gold into your retirement account without triggering tax penalties or early withdrawal fees. It covers the custodians, the storage, the IRS rules, all of it. If you're in that situation where you've got significant retirement savings and you're worried about what currency debasement means for your future, it's worth checking out. No obligation, just information that could be valuable for your situation. All right, back to where this price is headed. Because the breakout in other currencies isn't just a warning sign, it's a roadmap. When you see gold breaking out in yen, pounds, euros, and Aussie dollars, you're watching the early stages of a global repricing event. You're watching the market say that fiat currencies, all of them, are losing credibility. And the dollar is just the last one standing before the entire system has to reset. And here's the thing about resets. They don't happen gradually. They happen in lurches. You'll have periods where everything seems fine, and then suddenly, something breaks. A bank fails, a country defaults, a currency collapses, and the whole system has to reprice risk overnight. We saw this in 2008 with Lehman Brothers. We saw it in 2020 with COVID. We're going to see it again. And when we do, gold is going to be the asset everyone wishes they owned more of. Let's talk about the supply side for a minute, because this is another factor that almost nobody is paying attention to. Gold production has been essentially flat for years. The easy deposits have been mined. The ore grades are declining. The cost of extraction keeps rising. And there are no major new discoveries coming online that are going to change that picture. Meanwhile, demand is exploding. Central banks buying 1,000 tons a year. Asian consumers buying jewelry and bars. Investors finally waking up to the macro situation. You've got declining supply meeting surging demand, and that's a recipe for much higher prices. But it's not just about supply and demand in the traditional sense. It's about the paper gold market versus the physical gold market. Most gold trading happens in the futures market on the COMEX, contracts that represent gold but aren't actually backed by physical metal. For years, this paper market has been used to suppress the price. Banks and hedge funds shorting gold futures, creating artificial supply, keeping a lid on the price. But that game only works as long as nobody asks for physical delivery. And increasingly, people are asking for delivery. China is taking delivery. India is taking delivery. Central banks are taking delivery. And the COMEX inventories are draining. At some point, and we may be very close to this, the paper market is going to break. There's going to be a delivery failure or a force majeure event, and suddenly, the price of paper gold and physical gold are going to diverge. When that happens, the real price discovery begins, and it's going to be much, much higher than where we are now. Think about what's happening geopolitically, too. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create an alternative to the dollar-based system. They're settling trade in local currencies. They're building payment systems that bypass SWIFT. And they're backing their currencies with gold. Russia has been accumulating gold for a decade. China has been accumulating gold for 2 decades. They're not doing this for fun. They're doing it because they see the end game. They know the dollar system is unsustainable, and they're positioning themselves for what comes next. And what comes next is a multipolar world where the dollar is no longer the unquestioned reserve currency, where international trade is settled in a basket of currencies or commodities, where gold plays a central role in anchoring value. This isn't conspiracy theory. This is openly stated policy from multiple governments representing half the world's population. And if you're not positioning for this shift, you're going to be on the wrong side of the biggest wealth transfer in modern history. Let me give you a specific example of how this plays out. Imagine you're a pension fund manager in Europe. You've got billions of euros under management. Your mandate is to preserve capital and generate modest returns. For years, you've held German bunds yielding 1 or 2%. Safe, boring, predictable. But now inflation is running at 5, 6, 7%. Your real returns are deeply negative. Your pensioners are losing purchasing power every year, and you're watching gold break out to new highs in euro terms month after month. At what point do you say, we need to allocate to gold? At what point does it become fiduciary malpractice not to own the one asset that's actually preserving wealth? And when you make that decision, you're not buying 100 ounces. You're buying 10,000 ounces, 100,000 ounces. And there are thousands of pension funds, sovereign wealth funds, insurance companies, all facing the same calculation. When that institutional wave hits, the price of gold is going to move in ways that shock people. We're also seeing a generational shift in attitudes toward gold. Older investors remember gold as a relic, something their grandparents owned, not a modern investment. But younger investors, millennials and Gen Z, they've grown up in a world of financial crises, currency debasement, and broken promises. They don't trust the system the way their parents did, and they're open to alternative assets. Bitcoin, gold, real estate, anything that's not dependent on government promises. This demographic shift is just beginning, and it's going to drive demand for decades. Now let's talk about what this means for you personally. If you're watching this video, you're probably already aware that something is wrong with the financial system. You've probably already taken some steps to protect yourself. Maybe you own some gold, some silver, some Bitcoin. But the question is, are you positioned for what's coming? Because this isn't going to be a gentle decline. This is going to be a crisis that forces everyone to make decisions quickly. When gold breaks out in dollar terms, when it takes out 2,100 and starts heading toward 2,500, 3,000, the mainstream media is going to start covering it. CNBC is going to have gold segments every day. Your neighbors are going to be talking about it. And by the time that happens, you're going to be buying at much higher prices. The time to position is now, while gold is still consolidating, while most people are still skeptical, while you can still accumulate at reasonable levels. And it's not just about buying gold. It's about understanding the broader implications. If we're entering a period of currency debasement, what does that mean for your other investments? Your bonds are going to get crushed. Your cash is going to lose value. Your stocks might go up in nominal terms, but down in real terms. You need to be thinking about real assets: gold, silver, commodities, productive land, businesses with pricing power, assets that maintain value when currencies fail. This is also about understanding the timeline. This isn't going to happen overnight. The breakout in other currencies has been building for months. The breakout in dollars could take months more. But once it starts, once the momentum builds, it's going to move faster than most people expect. And the window to position at good prices is going to close quickly. I want you to think about the people who saw the housing bubble in 2006 and 2007. They knew it was unsustainable. They knew it was going to crash. But they were early. They were mocked. They were called doomsayers. And then 2008 happened, and suddenly they were vindicated. But here's the thing. The people who just predicted the crash didn't make money. The people who positioned correctly, who shorted the market, who bought gold, who protected their wealth, those are the people who came out ahead. We're in a similar moment now. The signs are everywhere. The debt is unsustainable. The deficits are exploding. The currency creation is out of control. The geopolitical order is shifting. And gold is telling you, in every major currency except one, that the crisis is already here. The dollar is just the last to admit it. So what do? You educate yourself. You understand the macro picture. You allocate a meaningful portion of your wealth to hard assets. You don't try to time the market perfectly. You build a position over time. You hold through volatility. And you recognize that this isn't about getting rich quick. This is about preserving wealth through a period of monetary chaos. The breakout in gold across multiple currencies isn't a random event. It's a coordinated signal from the global market that confidence in fiat currencies is breaking down. And when the dollar finally breaks out, when gold in dollar terms starts making new all-time highs and doesn't look back, that's going to be the moment when everyone realizes what's been happening. But by then, the easy money will have been made. By then, you'll be buying at much higher prices. The opportunity is now. The warning signs are flashing. And the one currency that hasn't broken out yet is about to. Don't wait until everyone else figures it out. Position yourself now, while you still can, and protect the wealth you've worked your entire life to build.